Hey everyone, we need to talk about what just happened in the last 48 hours. Silver didn't just crash, it imploded. 33% gone in 2 days. From $121 down to 78. That's a $43 wipeout. If you were holding $10,000 in silver on Wednesday morning, you're sitting on $6,700 today. That's $2,300 evaporated. Gold wasn't spared either, down 18%, from 5,300 to 47.45. But here's what mainstream media isn't telling you. During the worst moments of this crash, multiple exchanges and banks reported technical glitches. Trading platforms froze. Price feeds went dark. Orders couldn't execute. This wasn't normal. This was surgical. And the timing? Let me show you exactly what happened and why the next 72 hours will determine whether this was capitulation or the beginning of something far worse. This goes deeper than what you're seeing on the surface. Here are the 3 things that converged in the last 48 hours. First, the Kevin Warsh Fed Chair nomination on January 30th. President Trump announced Kevin Warsh as his pick to replace Jerome Powell in May. The market's initial reaction was relief. Warsh is seen as more market-friendly, less likely to challenge Fed independence aggressively. But here's what happened within 90 minutes of that announcement. The US dollar index surged. When the dollar strengthens that fast, commodities priced in dollars become instantly more expensive for every non-US buyer. Demand evaporates. Silver was trading at $114 at 9 a.m. Eastern. By 11:30 a.m., it hit 84. That's a $30 drop in 2.5 hours. Gold fell from 53.54 to 4,900 in the same window. This was algorithmic liquidation triggered by dollar strength and position unwinding across every precious metal simultaneously. Second, the technical glitches that nobody's talking about. The Boring Currency reported this yesterday. Multiple users on Reddit confirmed it. Twitter was flooded with complaints. During the steepest part of the sell-off on January 30th, between 10 a.m. and noon Eastern, several things happened at once. COMEX price feeds experienced delays. Certain brokerage platforms showed error messages when users tried to place orders. Some reported their positions were liquidated without margin call warnings. Others couldn't access their accounts for 20 to 40 minutes during peak volatility. Now, exchanges always claim this is due to overwhelming volume. High-frequency trading overloads the system. That's the official explanation. But here's the critical part. CME Group, which runs COMEX, raised margin requirements on silver futures during the crash. Not before it. During it. Normally, you raise margins to prevent bubbles from inflating. You don't raise them while the market is collapsing unless you want to accelerate forced selling. Every trader holding leveraged positions suddenly needed more cash to maintain their trades. Those who couldn't meet the new requirements got liquidated automatically. That selling pressure pushed prices even lower, which triggered more margin calls. Classic cascade. Third, the Chinese speculator liquidation that Yahoo Finance just exposed. This morning, Yahoo Finance published analysis showing Chinese leveraged traders were behind the parabolic rise in silver from $45 in October to $121 in January. That's a 158% gain in 3 months. But it wasn't sustainable. It was built on borrowed money. Futures contracts with 5-to-1, 10-to-1 leverage. When Trump's tariff rhetoric intensified in mid-January and the dollar started strengthening, those positions became underwater fast. Chinese traders faced margin calls in their own markets first. To cover those, they had to liquidate their most profitable trades, silver and gold. The selling started in Asian trading hours on January 30th. By the time New York opened, the damage was done. Stop losses were already triggering across U.S. markets. Retail investors in India, who piled into silver during the rally, got destroyed. Indian news reported silver lost 1,35,000 rupees in 2 days. That's 33.5%. Gold fell 18%. On India's budget day, February 1st, MCX gold and silver futures hit lower circuit breakers. Trading was halted because prices moved too fast. Investors couldn't exit even if they wanted to. Now here's the part that connects everything. These 3 factors didn't happen independently. Kevin Warsh's nomination was announced at a specific time. Dollar strength accelerated immediately. Chinese liquidation was already in motion from overnight trading. And right in the middle of the chaos, when liquidity was thinnest and panic was highest, technical glitches appeared and margin requirements increased. Coincidence or coordination? Here's what they're not showing on CNBC. So I pulled up the data this morning, and here's what the charts revealed. Silver opened January 30th at $115. By 10 a.m. Eastern, it was at 105. At 11 a.m., 90. By noon, 84. It briefly touched $74, the absolute low, around 1 p.m. before bouncing back to 78 by close. That $74 level is critical. It's exactly where JP Morgan closed their massive short position. according to COMEX data that surfaced yesterday on LinkedIn. A trader named Charles Monchot posted the report. JP Morgan had been short silver for months. They covered around $78. Think about that. Silver rallies to 121. JP Morgan stays short the entire way up, bleeding money. Then suddenly, within hours, silver crashes $43 and they exit their short right at the bottom. Either they have the best timing in history or they knew something was coming. Now, the 50-day moving average for silver sits at $92. We're 16% below that. Historically, when silver breaks its 50-day moving average by more than 15% in a single session, one of two things happens. Either it consolidates for 2 to 3 weeks and retests the breakdown level, or it continues falling another 10 to 15% to find the next major support. That next level is around $68. If we break 74 on the downside with conviction, 68 is the target. That would be a 44% drop from the high. But here's the interesting part. Volume on January 30th was the highest in silver's history for a single day. This wasn't low liquidity panic selling. This was massive institutional repositioning, real sellers, real buyers at the lows. The RSI, Relative Strength Index, which measures whether something is overbought or oversold, dropped to 18. Anything below 30 is considered oversold. 18 is extreme. The last time silver hit RSI of 18 was March 2020, right before it doubled from $14 to $28 over the next 5 months. I'm not saying we're about to double from here. The setup is different, but the technical extremes suggest we've reached a washout point. The question is whether this is the final flush or just the first leg down in a larger correction. The critical level I'm watching now is $85. If silver reclaims 85 by the end of this week, February 7th, it confirms the 74 low was capitulation. Professional buyers stepped in. Weak hands got shaken out. The bull market resumes after consolidation. If we can't reclaim 85 and instead drift lower toward 70, that tells me the structural support is broken. We're in a deeper correction that could last weeks, possibly into March. Now let's talk about the fundamentals, the real supply and demand picture. Industrial demand for silver hit 1.2 billion ounces in 2025, according to the Silver Institute. That's up 7% year over year. This is being driven by 3 unstoppable sectors. Solar panel manufacturing. Every panel requires about 20 grams of silver. Global solar capacity is expected to double by 2028. That's locked-in demand. Electric vehicles. Each EV uses about 1 ounce of silver in electrical contacts and circuits. EV sales are projected to grow 20% annually through 2030. Defense systems. Military electronics, radar, missile guidance systems. Silver's conductivity and reliability make it irreplaceable. Defense budgets are expanding globally due to rising tensions. On the supply side, global mine production reached 830 million ounces in 2025. Total demand was 1.2 billion ounces. That's a structural deficit of 370 million ounces per year. Here's the critical part. About 70% of silver comes as a byproduct of copper, zinc, and lead mining. When those operations slow down, which is happening now because of economic slowdown fears, silver supply gets squeezed even if silver prices are high. Now, China's 10-year government bond yield just hit 1.8% this week. That's near its lowest level in over a month. Low yields signal China is in easing mode. When China eases monetary policy, commodity demand typically increases within a 3 to 6 month lag. Chinese industrial buyers start restocking. Infrastructure projects accelerate. Let me put this in perspective. China accounts for 55% of global silver demand. When their economy shifts from tightening to easing, that's not a small variable. That's the biggest driver in the entire market. But the crash happened because of short-term speculative unwinding, not because industrial fundamentals changed. Solar panels still need silver. EVs still need silver. The deficit still exists. What changed was leveraged money got forced out. Smart money is already positioning. Central bank gold purchases hit 1,037 tons in 2025, according to the World Gold Council. That's the second highest on record. Russia's central bank added gold for 19 straight months through January. China increased holdings by 84 tons despite Western pressure. India bought 61 tons in the second half of 2025. They positioned when gold was at $4,500, back when sentiment was bearish. Now gold crashed to $47.45. But here's what today's move revealed about institutional positioning. According to Bloomberg data released this morning, silver ETF outflows were about 90 million ounces this week. During silver's rally from $45 to $121 over the past 3 months, fund holdings grew by 180 million ounces. Let me break down what this means. The big money accumulated 180 million ounces on the way up. Retail investors, late to the party, bought at the top. When the crash hit, 90 million ounces sold. The net position held by institutions is still significantly long at 90 million ounces above the baseline. They didn't panic, they absorbed the selling. I want to share something Kevin Warsh himself said in a 2023 speech about monetary policy and hard assets. He stated that central banks must hold real assets as insurance against currency instability. His view has always been that gold serves as a strategic reserve, not a speculative trade. And producers, the mining companies actually pulling silver out of the ground, they're locking in forward sales at $95. Compare that to today's crash level of 78. They're not panicking. They see the real supply and demand picture. They know industrial consumption is irreversible. Speculators reduced net long positions by 43% in the week ending January 28th, according to CFTC data. They still hold 68,000 net long contracts. For context, at the peak in early January, that number was 119,000. So we're not at extremes yet. Today flushed out weak hands, over-leveraged retail traders, and Chinese speculators facing margin calls. What remains are long-term holders and value buyers who stepped in at 74 to 80. The real question now is what's potentially happening behind the scenes with central banks and sovereign buyers. We've seen this exact pattern before. Back in March 2020, silver experienced something remarkably similar to what we're seeing today. Let me walk you through how it played out. Stage 1, the parabolic rise. January through early March 2020. Silver rallied from $14 in January to $18.50 by early March. That's a 32% move in 2 months. It was driven by easy money policies, industrial demand optimism, and retail speculation through platforms like Robinhood. Sound familiar? Silver just moved from $45 in October to $121 by late January 2026. That's a 169% move in 3 months. Stage 2, the crash. March 12 through March 18, 2020. On March 12th, COVID panic hit global markets. Silver crashed from $18.50 to $12 in just 6 days. That's a 35% decline. Compare that to today. We just saw silver drop from $121 to $74 in 2 days, 39%. Stage 3, the consolidation. March 19 through June 2020. Silver recovered to $15.50 by mid-April. It gave back about 20% over the next month as uncertainty persisted. Buyers stepped in at 13, seeing value. Physical premiums spiked, just like we're seeing today. The market tested the lows twice, once in late March at $12.75, again in mid-April at 14. Both times buyers absorbed the selling. Stage 4, the mega rally. July through August 2020. In July, during the infrastructure stimulus news and monetary expansion by the Fed and other central banks, silver made its final move. From $15 to $29 in 6 weeks. That's a 93% gain. The complete journey. Silver went from $18.50 to $12 back to $29. Net gain of 57% from the pre-crash high over 5 months. Where we are now, right now in February 2026, I believe we're in stage 2 transitioning to stage 3. Let me compare 2020 to today. Peak price then was $18.50 versus $121 now. Trigger event then was COVID panic versus Kevin Warsh Fed nomination and Chinese liquidation now. Percentage move during crash then was 35% versus 39% now. Key support level then was 12 versus 74 now. Our critical level I'm watching is 85. Based on historical timing, it took about 14 days to go from stage 2 crash to stage 3 consolidation. That puts our expected window somewhere between February 8th and February 15th. If this plays out proportionally, March 2020 recovered 40% from the low. The equivalent today would be 40% from 74, reaching about $104. Conservative estimate would be 25% to $92. But here's the key difference. In March 2020, the world had surplus silver inventory. Industrial shutdowns reduced demand. Today we have a structural deficit of 370 million ounces. Solar and EV sectors didn't exist at scale in 2020. They're massive now. However, 2020 didn't have aggressive Chinese speculative liquidation like we saw this week. Today's context is structurally different in this way. The selling pressure came from forced unwinding, not fundamental deterioration. The pattern doesn't repeat exactly, but the sequence and psychology remain remarkably similar. Let's make this personal. If you're holding a traditional 60-40 portfolio, 60% stocks, 40% bonds, here's what happened this week. Stocks dropped 3%. Bonds stayed flat. Combined, that's about a 2% hit on your total portfolio. On a $100,000 portfolio, that's $2,000 gone this week. Now, if volatility continues and yields rise another 50 basis points, here's what happens. Stocks would drop another 4 to 6%. Bonds would fall 2 to 3%. Your 100,000 becomes 92,000 over the next month. That's $8,000 at risk. Smart money is already positioning. Russia added gold for 19 consecutive months. China bought through Western sanctions and political pressure. They positioned when gold was below 5,000, back when everyone said the rally was over. Here's why I'm telling you this. The window is narrowing. Not because I know 78 is the bottom. I don't. Nobody does. We might go to 68 first. But the structural picture tells a clear story. Industrial demand for silver is locked in. Solar panels don't stop needing silver because speculators got margin called. EVs don't stop using silver because Chinese traders liquidated. Every solar panel removes 20 grams permanently. This isn't speculative inventory sitting in a warehouse waiting to flood the market. It's physical metal embedded in infrastructure for 25 years. I've been tracking this market since 2011, and I've never seen a setup quite like this. Parabolic rises happen. Crashes happen. But a crash driven purely by forced liquidation while industrial fundamentals remain intact? That's rare. Look, the question isn't whether we see more volatility or another leg down. The math is clear. The real question is, are you positioned for what comes next? In every previous crash, 2008, March 2020, even the mini crash in September 2021, hard assets preserve purchasing power while paper promises eroded. Right now, silver sits at $78. 85 is the key technical level. The next 2 weeks determine whether this was capitulation or the start of a deeper correction. I share real-time updates and deeper analysis on social media. For those wanting exclusive research and members-only analysis, there's a premium level. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations, but the data speaks for itself. All right, before you go, 3 quick things. 1. Drop a comment below. Tell me where you're watching from, and give me your prediction. Where do you think silver is headed by February 15th? 2. If you're not subscribed, hit that button now. I'm putting out unfiltered analysis 3 times a week. And listen, I'm fighting copycat channels stealing this content. If this video provided value, comment data over hype so the algorithm knows you're here for the original. 3. Next video drops tomorrow morning. I'm covering the one chart pattern that predicted both 2008 and March 2020. It's flashing again right now. Last time this signal appeared, silver doubled within 4 months. You won't want to miss it. See you there.